So now I should tell you the bad news. The bad news is somehow the New Orleans airport got shut down because it was iced in and they didn't have any rock salt. So one of our panelists and our moderator were not able to make it here. They were in New Orleans last night working with the CFA Society there, and never in 20 years has such an event occurred. And of course, I got the bad news at about 12:30 today, and been scrambling and refiguring. So it's going to be back to the future. I used to do the moderating, but then I discovered Vinny Catalano, and he does it so well and brings so many breadcrumbs from other societies and from the New York area. But I will be it. I have some of Vinny's notes, and most of all, I picked the panelists, so I know quite a bit about them, and they're absolutely first rate. So let me introduce the panelists and say a couple of words. Greg Valliere, I mentioned how I met Greg, and he later went on. Drexel went on also, but somewhere else. But he went on with several firms, including most notably was with the Schwab Washington Forum Group. I think he headed that. And I kept track of him, particularly when he was at Schwab, and somehow reconnected with him this fall when I saw that he was he produces a daily thought piece called Capital Notes on what's going on in Washington and what the undercurrents are and what the deals that may be in the works and the other problems, something that he has spent a career doing. He also is a chief global strategist at Horizon Investments, so he has a broad portfolio and can deal with some of the questions that Glenn Reynolds, who's the other panelist that's not able to get here because he's in New Orleans. Greg is a graduate of George Washington University, which of course is a short walk from the White House, so that's always been a great place to study political science. And he comes from just across the Massachusetts border, and Massachusetts is a place that's famous for launching politicians and political careers. So I've started in reverse alphabetical, so I will continue with that with someone that I've wanted for years, Luciano Siracusano, who is formerly the Director of Research and now the Chief Investment Strategist with Wisdom Tree. I've followed his career for several years and been to conferences where he did a terrific job presenting, including under very trying circumstances. So being a native of New York, Riverdale, I think he mentioned, and he went to Columbia University and studied some things besides finance, political science, as I recall, before getting into the investment world. And he survived and thrived, which is the key, quite a few years. One of the smartest people that I know. And then Charlie Bilello from Pension Partners. Has everyone heard of Pension Partners? A couple of people have, good. As I discovered them somewhat accidentally because one of their young geniuses, I'll say, approached about doing a program here. And he was so good, we brought him back 11 months later. He came in September, we brought him back in May when we had a cancellation. And someone from that firm has been here about every other year, including Charlie, who was on our panel 2 years ago. He has a law degree, he's a CPA, he's got a master's, he's got a bachelor's, business, various things. And he's a chartered market technician, a CMT. And there's probably a couple of other things. And most of all, he's smart and he's a great communicator. So his present to me on January 4th was a slide deck of charts of what had happened in the last year that was noteworthy, with some comments and just fabulous charts. I'm sure he'll talk about some of the themes, and you'll want to go to their website and get his chart deck. It's the best one I've ever seen come out in January. And these are folks that aren't household names yet, but probably will be someday, because my original studies were behavioral finance and sociology and psychology. So I'm always looking for what the culture is of firms I invest in or firms that you're going to collaborate with. And theirs is outstanding. Not that the others aren't. We only have first-rate folk here. So we're going to start off with a series of questions that I'll pose, mostly courtesy of Vinny sending them in to me late this afternoon from his list. And then after about 35, 40 minutes, we will switch and take questions from the audience. And of course, follow-ons. Then we will end about 7:45 or thereabouts. And the new way of doing things is the panelists don't get to eat until you get the treat. So, including the moderator. So we're going to start, I guess, alphabetically with Charlie Bilello in the middle. And Charlie, some are calling the latest run-up in stock prices a melt-up. Do you think that's what is going on? And what is a melt-up?
Yeah, we hear that word quite often, melt-up. I heard it, I don't know how many times since the election, right? Since election night in November 2016, we've been hearing that term, right? Melt-up, overbought, a lot of other things of that nature. We've done countless studies on the idea of does an extreme overbought market tell you anything about the future direction, near-term direction of the market? And the answer, whether you look at the S&P or the NASDAQ or any index globally, is no, it doesn't tell you very much at all. So the idea that something that's overbought can't continue to get more overbought or go sideways or continue to go higher is just not true in markets. Markets tend to go up. When they go up in a strong fashion over a short-term period, it's not actually a negative. So it's not the inverse of, let's say, an extreme down move where you tend to see mean reversion properties and future outperformance. So is it a melt-up? That's in the eyes of whoever's defining it. What I will say is that we should have some context. So this is a very different market environment than when I was here 2 years ago. 2 years ago, we were in the midst of around a 15% correction in the S&P. Small caps were down roughly 25%. Emerging market stocks hadn't had a positive year in a long time. You had crude at below $30 a barrel. You had people worrying about recession. Today, none of those things exist. So entering the year, the S&P 500 at the end of last year, entering the year, if you look at a valuation basis, if you look at something like the CAPE ratio or Shiller PE, it was above 30, around 32. And if we look historically at the data, Shiller data going back in time, there's only two other time periods in history where we've seen similar valuations. The first was in 1929, September 1929, and the second was started in July 1997. So everyone remembers what happened in 1929. There was a crash, markets went down over 80%, there was a depression. A lot of people don't talk about the second example, which was started in the mid-90s, where the markets were overvalued and they continue to get more overvalued. So context is important. U.S. markets, whether you want to call it a melt-up or anything else, are at the extreme end of historical valuation. So the Shiller P or CAPE ratio is higher than 97% of historical time periods. When you look out 5 to 10 years forward from such valuation extremes, tends to be below average returns, but it doesn't tell you very much, again, about the next year. So entering the year, the S&P is up 9 years in a row. The only other time in history it's done that was from 1991 to 1999. And investors are feeling pretty good about the market today, whereas 2 years ago they weren't. So melt up or not, I think the broader issue today is what's reflected in the market and what are investors' expectations. And 2 years ago, the expectations were very low in terms of sentiment, and today they're pretty high. So I want to save a little bit of that for later, but that's the context where we are in terms of the market.
Okay, well, investor sentiment is my next question, and I'm going to direct it to Greg since he commented upon this in a Barron's interview in October on investor sentiment. But in that regard, I remember in 1999, which was the biggest bubble in my lifetime, the expectation by the average investor was that they were going to do 18 to 20% a year going forward. I don't know what that expectation is now, but hopefully it's close to the really long-term average, around 9%, which I learned in 1964 is an accident since I was brought into a brokerage office and left there. And they had just published a study from the University of Chicago, CRISP study. And of course, in 99, the long-term average got as high as 13, a little over 13%, somewhere 9 to 10%. Greg, what do you see happening with investor sentiment other than at the White House?
Well, I'd have to say that one of the great challenges in my career is telling investors they have to divorce two issues. One issue is the constant tweeting, the scandals with Trump, the embarrassing things he does, mocking John McCain, on and on and on, but they don't affect the market. And you have to tell clients that their focus must be on the fundamentals. So you've got GDP growing at 2.5%, maybe better. You've got a very strong labor market. You've got an inflation rate that's still tolerable. You've got great corporate earnings. So the fundamentals are just absolutely wonderful. But you have to tell people, many of whom become agitated by what goes on in Washington, that the two issues have to be divorced. And I think that one could ask for no better example than in the last week when Trump said some pretty outlandish things about Africa, and I won't go into all that. And the market surged this week. The markets don't care about that. They only care about earnings, things like that, and earnings have been great. So I think a cardinal rule in dealing with investors, maybe your clients, is to tell them they have to divorce themselves from the scandals and the tweets and look at the fundamentals.
Or as I learned a long time ago, don't mix politics and the stock market. Yeah. I saw so many of my Republican neighbors miss bull markets because a Democrat was in office. Yep. And as you know, the long-term record is those years on average do better than when a Republican's in office. You could rejoin, that's because they had a lot of wars when Democrats were in office, but unfortunately the Republicans have been catching up since Nixon. Pardon my editorial. Greg and I both remember personally 1987. How many other people experienced 1987 as an investor? Okay, there's about a dozen of us, and some of you don't look old enough, so you must have been investing in grade school. But that was a time when we did have a melt-up, and it was the one time that we went to significant cash because you didn't need a CFA charter, and I didn't have one in 1987. It came a couple of years later. To know that when interest rates go up from 7 to 10%, and the market goes up 30%, and Congress is at work monkeying around with the takeover laws, trying to stop entrenched managements from getting thrown out, that bad things were going to happen, and boy, they sure did, with the help of technology. And technology always seems to be involved with major market tops. And that was certainly a significant market top, but it did not result in a depression or even a recession. And it was one of the more fascinating markets. So since then, and for the last 3 or 4 years, I've been worried about a melt-up. But the good news is, and I view the market day by day, that it hasn't been concentrated in one sector like tech. It's been very broad. And the market until today had never gone up more than 200 points in the last few years. And 200 points on the market level now on the Dow is not significant percentage-wise. So now it's time to bring in Luciano. And we're going to ask you first about April of last year on CNBC. You stated that emerging markets were a very attractive place to invest. Since then, they've far outstripped the major regions, including the U.S. Do you think they're still a good place for investors? And you may have some ideas on specific markets.
The short answer is I do. I'm going to come back to emerging markets in a second because I want to tie it into the first question around the melt up, because it's interesting. I don't remember that word coming into the lexicon until people start talk about meltdowns. And the first meltdown that I remember was Chernobyl, 86, that ended up poisoning milk 1,000 miles away, tragically. But when you're talking about a melt up, I always think of it in terms of what's changed almost at a molecular level within the market's nervous system that sets off a chain reaction where you keep getting almost a self-feeding mechanism fueling things higher. And I don't think we're there yet. Certainly not anything like what we saw in the late 90s. I remember in the late 90s I was working at Valliere and literally feeling like the inmates were running the asylum, where people who were posting on message boards could move stocks and take them up. But in a real melt-up, you'll see people talking about the stock market in barbershops. You see them talking about it in cafes. CNBC used to be on TV everywhere at the top of the market. So I don't feel in terms of sentiment that we're there yet. The other thing that's important in the last 7-8 years since the financial crisis, the retail investor hasn't really gotten back into the market. There's been about $1 trillion that have left equity mutual funds, and they've gone into equity index funds, index mutual funds, but primarily into exchange-traded funds. And so you don't really get a speculative top until the retail investor gets back in. So I don't think you're there yet either on that count. Now, with respect to emerging markets, we're still very constructive on it. If you were buying emerging markets last year and just got exposure to the broad index, you were up about 37%. The S&P was up about 22. MSCI EAFE was up about 25% in the developed world. And a lot of the money that came into the ETF industry last year, and we saw record inflows, about $500 billion. The majority of it came into so-called low-fee beta products, some of which was, even below 10 basis points, some of which was below 5 basis points. And if you asked me what's pushing equity values higher, I would say part of it is the fact that people are indiscriminately buying beta. And when you buy beta, you're price insensitive. You're not particularly attuned to whether or not the S&P is trading at 18, 19, 20, 23 times earnings. You're just putting new money to work. And that's one of the things I think is driving the market higher. The other thing I would say to keep an eye on is, do you start to see people coming out of bond funds? Because that's where a lot of the retail money went over the last 8-9 years. And you've seen now in the last 3 months, the last 6 months, if you've owned the ag, you're basically down on an NAV basis. If you've owned many bond funds, you've missed out on this, quote, melt up in the equity market. And that's the kind of thing that can push the new money at the margin into the stock market. And if it's done on margin, that's the thing I think that you should be looking out for in terms of, are we getting close to a speculative top? But I don't think we're there yet.
Interestingly, the technology component of the S&P was also up 37% last year, but it did not become a craze or bubble like it did in 1999. I have a favorite cartoon, which I didn't bring, but I show when I do presentations, and it basically, I put the sobriquet, the words under it, and when pigs are flying, it's best to be inside or out of the market. And when, crap is going up, and when people who have no knowledge are being successful at appearing to get rich quick. That's when you're in the real bubble. I haven't seen that yet, and I don't travel in the Bitcoin circles, but a couple of investment conferences I went to last year, that along with marijuana was the hot new issue. There wasn't a lot of interest in stocks. Now, some of us, and I should have mentioned, will be going to the Inside ETFs conference at the Diplomat in Hollywood. Are there any other people going? If you're a member of the CFA Society or have a CFA charter, there's a discount. And you can sign up online through Friday at 5 p.m. Inside ETFs. And we can give you the discount, the little code, but it basically has CFA on it. If you're interested, I think it's about $500 now. One of the good fortunes is where we live, we have a lot of folks come here in the winter. And that's been a great conference for years. And even before it was the current management, it was run by NASDAQ, and they used to give us free admission for board members and a big discount for society members. And did some great things, and then it got even bigger. And that has been an area, I don't know if it's a bubble, it's certainly a new technology. And of course, there are areas they can quickly, apparently very quickly do an ETF, but they haven't done one yet in Bitcoin, have they? They did get futures, and they saw where that helped out today, is now the professionals could short them. And I think Bitcoin was down 15 or 16%. Luciano, do you know if there's a Bitcoin ETF yet? Or?
As far as I know, there isn't. I do know the regulators are looking at it carefully. I think they're very cautious about it. There are certain countries now, including Korea, that are banning Bitcoin. They're afraid both of this speculative bubble, but I think they also want to make sure they don't let something into their monetary system that they might not be able to put the genie back in the bottle once it's let out. So the interesting thing about Bitcoin, and Barron's did a piece on this a few weeks ago, is it was really an individual investor phenomenon, particularly among millennials. And now with the advent of the futures, Wall Street is getting involved, but Wall Street is basically being asked to buy this after a huge speculative run-up. So it's kind of the opposite of what usually happens. The individuals are putting back a very expensive priced asset class, if you want to call it, back to the people who trade futures on Wall Street. So I do think you will see something coming in Bitcoin in the next year or two. It might come in Europe first, but it's certainly a subject of a lot of discussion, a lot of debate. It doesn't occupy too much of our thinking, frankly. I think the technology blockchain is interesting. It'll probably have a big impact on the financial sector. But my issue with Bitcoin is what prevents the second Bitcoin from coming out. I know it's analogous to Facebook. Once you get the platform and you get the user base, you've kind of locked it up. But I've seen, the second and third and fourth and fifth iterations of future cryptocurrencies. And if the reason you're buying the cryptocurrency in the first place is because you don't trust the central banks to print currency, why would you trust it to anonymous digerati who can continue to just create cryptocurrency ad infinitum? And you could have 10 cryptocurrencies competing against each other 10 years from now, and what's to stop the dilution of the cryptocurrency? So I can't get my head around why anyone would be buying it at these levels.
That's why human behavior is so fascinating, and generational behavior. So now we'll move on to politics. It plays a key role in the government policies that we get. And the two issues on the plate right now are a potential government shutdown now or later, or somewhat even more later. And also the 2018 midterm elections and how they can influence these factors, and could Congress change? And Greg, I get your piece every morning about 5. I'm not looking at it at that time, but you're on top of things. is my point. What are your thoughts on these two issues?
Well, there certainly could be a shutdown on Friday at midnight. They're so far apart on not just immigration, but on spending levels. The Republicans want a huge increase for the Pentagon. They'll get it. But the Democrats are saying, fine, you get that. We want an equal increase for domestic spending. So that's an impasse as well. There could be, I was on the phone this afternoon, Paul Ryan may come up with a deal to extend this. We go once again to kicking the can down the road until February 16th, in which we go through this all over again. The main problem is that there is no agreement on immigration, and I don't see an agreement anytime soon. The president is still insisting on quite a bit of money for a wall that's a non-starter for the Democrats. So this is going to go on for a while, and it's one of two issues that will really affect the election. The other issue, of course, is the almost certain resumption of indictments by Robert Mueller. Now, you may say Mueller is compromised, that he's partisan. He's been, I think, stung by criticism in the last few weeks, but he's not going away. And there are indictments coming. I think Jared Kushner and Donald Trump Jr. could be indicted. D.C. is so liberal, you can get a jury to indict just about anyone in this room on a perjury charge. So, I think there'll be more indictments. Maybe it's perjury, maybe it's money laundering, but that will have an impact as we go into the fall election. So as far as the election goes, I won't go through all the races. I think that it's safe to say that the House is now really in play, where a 24-seat pickup by the Democrats would give them control, not out of the question. Senate's a little tougher. There are an awful lot of vulnerable Democrats in the Senate who are up for re-election. That could be tougher. But the most important point for all of us, I tell all my clients, and I write about this a lot, is that even if both houses went back to the Democrats, Trump would still have his veto. Trump has a veto that will not, I think, be overridden. I think that will be good for his last 2 years. So he does have a base of support in the Senate that I think will not erode. Well, one final point. I talked to an awful lot of Republicans who in private despise Trump. They loathe Trump, but they will not say it in public because they know if they do, they're going to lose their next primary. Trump's support in the Republican Party is something like 80%. I think that's something people overlook. With an 80% support level within the Republican Party, Trump still has an awful lot of cards that he can play.
Okay, and for Charlie, in a recent report you published, you showed that sentiment on one measure was the highest bullish level since the mid-1970s. Does this concern you, or is it just a singleton?
So yeah, if we're looking at various sentiment measures historically, if we look at investors' intelligence, we have data going back to the 1960s. If we look at the spread between bulls and bears last week, that was the highest since 1987. If we're looking at individual investors in the AAII sentiment poll, we're seeing pretty widespread historically, higher than 95, 96% of historical readings. And when you look at this data, sentiment data, on the bullish side, it's not exactly the same as on the bearish side. So 2 years ago when we were sitting here, we had the reverse situation in these polls. You had extreme bearish sentiment. And I said at the time, what you tend to see following extreme bearish sentiment is above average performance going forward over the next year or so with above average chance of a positive return. When you have extreme bullish sentiment, you don't have the same statistics. What you do show historically is significantly below average returns, but depending on how you segment it, usually still positive or flat performance with a lower probability of a positive future return. Now, there's many, many exceptions within that. So there's been times in the past where sentiment has been this extreme and the market continues to go up. There's other times where bear market starts to read. So these are just averages. So the probabilities would suggest that during times of extreme sentiment, ignoring everything else, you have a lower probability of an above average return and a lower probability of a positive return going forward. So you can combine that with other things. We just talked about valuation. I think the most interesting thing from a sentiment standpoint and why people are feeling so good about the markets now and why they were feeling so pessimistic 2 years ago is the lack of volatility and the lack of corrections. So the S&P has now gone 14 months without a pullback greater than 3%. And that's far and away the longest period in history. And if you remember election night in November of 2016, the volatility that went on that night, and the S&P was limit down, all global markets were selling off, gold was rallying, treasuries were rallying, and the expectation after that election night was regardless of what was going to happen in the markets going forward, you were going to see volatility around that, right? So what did we have last year? We had one of the least volatile years in history, right? So from a sentiment standpoint, there's nothing that makes investors feel better about an up move without any variation. So in the late 90s, where I was talking about earlier, we had similar valuation extremes. But you started to see more volatility around that, especially in 1998. Everyone remembers the over 20% decline in 98. We had a LTCM, Russian crisis around that, but you had some volatility. Even in 1999, NASDAQ was up 80%, S&P had a 20% year, but there were many, many corrections greater than 5%. From a sentiment standpoint, I can't blame investors for feeling pretty bullish now, but the concern for the future is that perhaps they've gotten they're too excited here and now, right? So everything that we're talking about seems perfect. We're talking about tax cuts that are going to boost earnings, going to boost GDP, right? We're talking about all economic numbers, the best we've seen in a long time. If we're looking at unemployment rate, we're looking at consumer confidence, we're looking at manufacturing surveys. Pick any one, right? They've been the highest they've been in a long time. The problem with looking at the statistics and starting to feel good about them is when we break it down, if you look at the periods following low unemployment rates or high consumer confidence, you again see below average returns going forward for the markets. So you have to really break down sentiment into what's the underlying backdrop behind that sentiment. Are investors really bullish, but valuations are cheap? Okay, then maybe overlook that sentiment. Maybe the market continue to push higher. The difficulty here and now is that valuations are stretched. If we look at the credit markets, we're seeing the lowest credit spreads in high-yield bonds since 2007, all right? 2 years ago, high-yield spreads in the Merrill Lynch index were over 800 basis points when I was here. Now they're 300 and change. Investment-grade credit spreads are below 100 basis points, lowest again since 2007. So risk appetite has broadened to pretty much all asset classes, and I don't think that what's going on in cryptocurrency is happening in a vacuum. It's something like that type of mania can only go on in an environment where investors are only focusing on reward and not risk. So I think what you saw on cryptocurrencies last year speaks to the broader environment of risk appetite. And maybe in the past that money would have went into tech and it would have, but now they're just chasing the most volatile asset, right, imaginable. So that's a long-winded answer to your sentiment question. There's no hard and fast rules in markets. That's the truth of it. They're just averages and they're just probabilities. So are investors very bullish today? Yes. In the past, has that meant a more difficult environment going forward? Yes. But were there times where the market kept running? Yes, too. So you have to keep all that in mind. I wouldn't trade off any one of these indicators. We certainly don't. But I would just keep that in the back of your mind that obviously people are feeling pretty good. And for many reasons, they're feeling pretty good. What are they missing? And what are they expecting in markets today that isn't going to be met? Whether it's in terms of how much corporate earnings are going to be boosted, how much GDP growth, right? The Trump administration is talking about 5-6% real GDP growth. Is that a realistic expectation from 2% where we are now? And how much of that is priced into the market? That's always the most difficult question.
Okay. Thank you. Greg, it's time to talk a little politics again. What are your thoughts regarding trade wars? The issue keeps popping up. Is it real? Is it a false or a ploy? What are your thoughts on the key trade agreements like NAFTA?
I feel like an idiot talking about things to worry about since we're up 300 points every day in the market, but there are things to worry about, and most of us, I think we'd all agree, we're paid to worry for our clients, and there are some things to be concerned about. I would say trade protectionism is high on the list. I could see us pulling out of NAFTA. I think trade disputes with China are going to be a big geopolitical issue along with Korea, along with Iran. I do think trade protectionism is something we're going to hear more about. A couple other things I'd just say that I worry about personally. One is nobody in Washington really cares about the deficit. It's disappeared as an issue. You talk to people on the Hill in both parties, and they say, the markets are fat and happy. Why should we worry about the deficit? Well, you look at any reasonable projection for the next decade as we all get older, there's a real problem in dealing with entitlements, in dealing with spending. So what are we going to see in the budget deal that we finally will get later this winter? Dramatic spending increases. Nobody is talking about curbing deficits. That's still another thing that I think you have to worry about. And then finally, just on the geopolitical front, I think that Korea can be just an uneasy stalemate for the rest of the year. But I got to tell you, there's something that worries me. If they could screw up in Hawaii and think that there was an incoming missile, well, what if we decided those sons of guns, we're going to retaliate against North Korea? And those of you who are students of history know that we basically stumbled into World War I in the summer of 1914. Just miscalculation after miscalculation. Could we stumble into something with Korea? Could we stumble into something in the Persian Gulf? So this is not a world that is devoid of things to worry about. I'm hardly a bear. I think the fundamentals are great. But there are things to be concerned about, and I would put trade protectionism high on the list.
And how about the issue of the U.S. dollar being surprisingly weak? Does this concern you? And I know Charlie has done some work on this, and Luciano follows currencies as part of his ETFs. So do you have a comment on the dollar? Does it matter? And being low, is that positive or negative, or does it depend?
Well, let me start, and then I hand off to Charlie. I would just say predicting movements of currency is really hard. Last year we thought the dollar would strengthen because Trump was coming in. There was going to be tax cuts. There was going to be regulatory relief. We thought you would likely see higher interest rates, faster GDP growth, and the central banks overseas were continuing to print and keep their yields at zero or less than zero. So for all those reasons, we thought the dollar would probably appreciate in 2017. It didn't. It actually declined about 8.5% against a basket of developed and emerging currencies. So I would just say it's always a little bit of a risk to try to predict short-term movements in currencies. Typically, most of what's out there has already been baked in because the currency market is so broad and so many folks are playing in it, that what really moves the currency markets are things at the margin that haven't been baked in yet or expectations that don't get fulfilled. And I think one of the things that happened about midway through last year was people started to think about when will the ECB and Mario Draghi take their foot off the pedal and start telegraphing that they may start to slow down their QE printing. Most people don't realize this, but last year the European Eurozone grew faster than the U.S. economy did. Germany grew faster than the U.S. did last year. And yet their interest rates have been, frankly, close to zero when the Fed here has been hiking and tapering. And people are saying, well, when are they going to stop their QE printing if their economies are starting to come back? There's also, a general sense that we may not be able to move all that much higher on the long-term rates. The long-term rate, the 10-year yield, is really what has the biggest impact on the direction of the dollar. So you've seen the Fed raise short-term rates, but the 10-year pretty much ended last year where it started the year. And it's still incredibly low at 2.5%. And the question is, what is that telling us about expectations for GDP growth going forward? Is that a real number, or is it only 2.5% because German bonds are at 30 bips and Japanese 10-year paper is at 0. So I would just say generally, it's hard to make a call on currency, but if you do believe, that the dollar is starting to give up some of its strength that it had over the last 5-6 years, that's a good thing for U.S. multinationals. You saw that last year with U.S. large caps, particularly technology, benefiting from that. It's also, good for global GDP growth. The fear is if you get dollar strength and you start to put too much pressure on European companies and emerging market companies in particular that have debt denominated in dollars, that can slow down European and emerging market growth. So right now, I would say we're in the sweet spot of synchronized global growth. You're going to look and see around the world, Japan's growing more than 2%. They've grown 7 quarters in a row. You look at India and China, they're growing 6 to 7%. Europe is doing very well. And the U.S. right now, of 3% growth last quarter, is the fastest growing developed country in the world. So you really could be in the sweet spot of growth for the year ahead. And I would say if the dollar can just stay in the range where it is, I think it's very constructive for equity values and for global growth in 2018.
Did anyone say Goldilocks?
That sounds like it. My thoughts on the dollar, I've written a lot about the dollar, and it's there's a lot of irrational fears attached to the dollar in both directions. But if you look historically, the history of the dollar index, and you run a correlation versus the S&P, you'll find that it's about as close to 0 as you can get, which means that even if you could tell me where the dollar is going over the next year, I would have no basis to predict what the S&P was going to do. Now, why is that the case? Is it because the dollar is not important? Not at all. It is important. It's that you can't, even if you could predict the direction, you need to predict the direction and also why it's moving in that direction. So if you could tell me that the dollar is going to be strong, and it's going to be strong because central bank policy in the U.S. is tighter than the rest of the world, and it's not because of improving growth in the U.S., well, that might be a problem. And that's precisely what we saw from mid-2014 to early 2016. The concern was, okay, stronger dollar led to an earnings recession in the U.S. You had over 8 consecutive quarters of negative earnings growth for multinationals. You had also the crash in crude oil and the impact on energy companies. But you could look at many other periods where dollar strength hasn't been a problem, right, in the 80s and the 90s. Same thing with dollar weakness. If the dollar is weak because U.S. growth is weak or weak relative to the rest of the world, that can be a bad thing. But if it's weak because the U.S. Fed is easier than the rest of the world, and what seems to be going on in the past year is the expectation that the rest of the global developed central banks will finally begin to start to move towards normalization, as the U.S. has started to do. Now, we've only seen small signs of that today. Entering the year, every major developed country central bank in the world was maintaining negative real interest rates. And that should be a shock to you because we're 8.5 years into a global expansion, and every major global developed central bank is maintaining crisis-level monetary policy. But the expectation seems to be, if you look at the action in the euro and the pound and some of these other currencies, it seems to be that that's going to change, right? The Bank of England did hike rates last year. The Bank of Canada moved as well a few times. They moved again today. You're starting to see some other movement amongst global central banks. The big one, of course, will be the ECB. They're unwinding their quantitative easing program. If they follow the U.S. script sometime after that unwind, they'll after that taper, they'll hike rates. I mean, they're in negative rates in Europe, and with German bunds negative through 6-7 years. This doesn't make sense when you have German GDP growth and German inflation roughly equal to U.S. growth and inflation. So there's every reason in the world to believe that normalization is going to occur, and that seems to be what's going on in the currency market. But I'd be very wary on predicting not only where currencies are going to go, but how that's going to impact markets. Now, certainly a weaker dollar is going to help U.S. International investments, certainly benefit to to European stocks and emerging market stocks if you're a U.S.-based investor, and that's certainly been a tailwind. So we'll see if that will continue. But there's so many factors that are impacting the dollar. It's just it's pretty much a fool's game predicting where it's going and how that's going to impact the markets, in my view.
Okay, the final question before we turn it over to the audience is, most of us that have been around for a while know that when things are too good, there's always a negative surprise coming. It's unexpected. So where are our vulnerabilities? Where could that be coming from? And it usually involves something like hidden leverage. I know Charlie and his team have just finished a big study on the use and misuse of leverage in investing. And Luciano, with ETFs, have ETFs become too big and too influential? Is there a lack of liquidity or hidden leverage there, or will it be able to handle any types of funds? And also want to get Greg's thoughts. So Charlie just spoke, so it's, I guess, Luciano's turn.
Yeah.
Are ETFs too big, or is the danger somewhere else?
I would say it's somewhere else, but I'm speaking from the ETF industry, so take that with a grain of salt. The ETF industry is about $3 trillion of assets. Okay, the number of ETFs that are so-called leveraged is a tiny, tiny fraction of that, and the $3 trillion in ETF assets is a small percentage of the global assets that are invested. Mutual funds, for example, still have 7-8 trillion invested in equities. There's another couple of trillion in bonds. Indexing, I don't think, has reached the point yet of being a market-dominating force. I think it's influencing some behavior, but I don't think it's at the point where it's anything near like a destabilizing force. If you ask me what do I think ends the current bull market, you know, the stuff always comes out of left field, but you know, the one thing that gives me some concern is that it's basically been a tech-led, NASDAQ-led rally now for 5 years. And if you look at the top 5 holdings in the NASDAQ 100, about 40% of the entire index is comprised of those 5 companies. It's Apple, it's Microsoft, Facebook, Google, and Amazon. And of the 5, Microsoft's really the only one that's had an experience where the government went after it. And they went after Microsoft on antitrust 10, 15 years ago and pretty much stopped Mr. Softy in its tracks. Microsoft was never the same company, and the stock was never the same after it went through that. It took almost a decade for Microsoft to get its mojo back. The risk for me is that you move into a new environment where people feel they need to start regulating or policing Facebook and Google because of the power they have over the public square, that the legislators start to view them not as technology companies, but as really media companies. And then the question is, are they media companies that are in effect providing almost a utility to people? There are lawsuits right today going through the courts against Google, basically saying, you know, Google violated my First Amendment free speech rights by demonetizing my ability to broadcast my videos on Google because of my political speech. And if they get to the point where the government is going to make Google or Facebook monitor more what they do, meaning hiring more people and getting involved with a lot of compliance costs, that can kind of change the game for those 2 companies. And they're taking in 60 to 70% of all the new ad revenue. They're really phenomenal growth engines because they've been allowed to be free and to compete, you know, with very, very little government oversight or intervention. So I would say anything that creates regulation for Google or Facebook, watch out for, and anything around antitrust or on Amazon. Amazon has a projected earnings for the coming year of about 90%. They're trading over $1,100 a share. They have a huge multiple to support. And anything that changes in terms of temperature around regulating Amazon, because they're going in and buying out all the grocery stores and basically killing everyone. They're a wrecking machine on retail. Eventually, people are going to say, hey, isn't this kind of like a trust? Isn't this a monopoly? Doesn't this company starting to have too much power? Those are the things I think that could kind of derail the leaders, and it's always the leaders in the bull market that get taken out and run through the snow by the bear. That's how bull markets end. You take apart the generals. So I would say anything that impacts those 5 companies, I would say look out for.
So my candidate of what maybe to worry about is not impeachment, it's not scandal, those are on the table. My candidate would be that we could start to overheat. As I travel around the country, I'm astonished when I ask business leaders, what's your biggest problem? Obamacare? No. Regulations? No. Lack of skilled labor is almost the unanimous answer I hear from people, in not just pockets of the country, in virtually all of the country. And I would add, I'm hearing another answer more and more, and this is not a joke. More and more business leaders say, we can't find enough people who can pass the drug test. And that's something as a country we're going to have to start worrying about. I've talked to people in states where marijuana is legal, and they say, well, we may be able to hire people around marijuana, but we're going to hold the line on cocaine. Or, that's a problem. That's a problem when you have a labor market that is this tight, when you see unemployment now down to 4.1%, maybe going down further. And I do think with all the stimulus, the tax cut, both corporate and individual, with monetary stimulus for the last few years, that we do run a danger of overheating. So I think the new Fed chairman, Jerome Powell, who's not quite as dovish as Janet Yellen, nobody was as dovish as Janet Yellen, I think Powell's probably going to have to raise rates 2 or 3 times this year. And I don't think the markets are going to freak out if the Treasury 10-year bond yield gets to 3 or 3.25 or 3.5. But the direction, I think, will be important. And I think that direction on interest rates will be a result of the fact that we have an economy that's overheating with a budget deficit that is taking off.
Well put. Charlie, your thoughts?
Yeah, I guess by definition, black swans are, you can't predict them. So it'll be something different than any of the prior cycles, right? It won't end the same way as it did in 07 or 2000 or 1990. Most of the difficult bear markets are associated with recession. Today, there's no indication, looking at leading indicators, that we're close to a recession. Those leading indicators only have visibility very short period of time. If we're here a year from now, maybe that's different. But you can have market shocks and market, we saw in 2011 and in 1998 and 1987, you got market shocks away from recessions. And those are certainly different situations and maybe even harder to anticipate. In terms of what I'd be worried about as an investor, everyone in here is probably using some form of asset allocation for either themselves or their clients. And what I'm thinking is no different than what Cliff Asness has been talking about or Rob Arnott has been talking about. It's a difficult time for prospective returns. If we look at the average bond fund in the U.S., it's still yielding around 2%, even though the short end is rising. Still, you're yielding around 2%. The best predictor of bond returns, bar none, is the beginning yield. So let's say over the next 5 years, you get 2% from bonds. You look at the U.S. equity portion of the valuation spectrum. We already talked about that. You're expecting below average returns. Doesn't tell you anything about a year from now, but 5 to 10 years, likely below average. Look at risky credit, junk bonds. Again, you're looking at among the lowest yields in history. European junk bond yields are below U.S. 10-year yields. Just an incredible statistic. So the easy thing, I guess, would be is to say that this normalization will lead to a change in market behavior. So for the Fed, we've seen a negative real interest rate. If we're looking at Fed funds minus core CPI, we've seen negative real interest rates in the U.S. For over 100 months and running. And I think it's 116 months. Prior to this period, the longest period in history of negative real Fed funds rate was 39 months, and that ended in 2004. And many people consider that to be one of the proximate causes of the housing bubble in the U.S. So the question for investors today is what is this easy money leading to in terms of extremes? And is it just going to, it's obviously going to things like crypto, but is it just bidding up everything to the point where you're pulling forward returns. And the math is going to be against you, maybe not in the next year or 6 months or 2 years, but at some point there has to be a mean reversion in terms of returns, and perhaps it's easy money that's caused that, or perhaps it would have happened anyway. We'll never be able to prove the counterfactual of what would have happened. But if the Fed indeed does hike 3 more times, as the market is expecting, and as the Fed is projecting for the first time since 2008, they're going to have a Fed funds rate that's above the rate of inflation, around 2 and 2.25, depending on where inflation goes. So that's a change in the marketplace, and the ECB going off of negative rates potentially, and other central banks in Europe doing the same. These are changes, right? So that inflation can be a good thing if growth exceeds it, or it could be a difficult thing for markets. I don't have any prediction. I just would expect the change in market behavior to start to result. And that could be on the upside in the near term. Maybe that we're seeing the beginning of that now, where market could continue to go up, but you're going to have more volatility around that, and that would be similar to what we saw in the late 90s. Or it could be more problematic and lead to something shorter term. We don't know. So no one knows what the next crisis will be. We just know that it'll be different. And looking at monetary policy, that's the most different. 8.5 years into an expansion, to have monetary policy where it is, that's unprecedented. And so we shouldn't expect what happens next to follow any historical script. I don't think it will.
Okay, thank you. You've heard from some pretty bright and knowledgeable people, but now we're going to hear from the best and brightest in the room, our audience and our members. So I'm sure you have some questions or want to follow up on some of the issues that have been dealt with already. And you mentioned Janet Yellen, and one of the intriguing thoughts that came to my mind was she could have been called Goldilocks, but Mr. Trump, never used a negative or demeaning sobriquet for her about the only female or official that he hasn't yet. It's interesting. My father taught me that the most powerful person in America, other than the president, was the head of the Federal Reserve. This was back when I was a kid in the 1950s. And as you know from history, they did a lot of harm, as they didn't know what they were doing. But now from the audience, what's on your mind? What have you run across that we may not have seen? What's the biggest issue? Yes.
I have a question for Greg. Greg, can you talked about the midterm election looking out. Can you talk a little bit, in history, have you seen any time almost like a public-private partnership where the government's come out with the tax reform and the private sector has now come out with, forget whatever they're going to be saving in taxes, but giving out to the shall we say the common worker? What kind of an impact does that have on the midterm election, where people are getting a bonus that they never really expected? And a follow-up to that is more global. Can you also comment on the implication that we had the German election back in September, and to date we don't have a government in Germany, and the markets have completely ignored that, following with the election in Italy in March this year?
Well, there's so many moving parts, and I'll just cite two for the sake of brevity in the upcoming election. The White House narrative, which has merit, is that this economy by Labor Day could be growing at 3% with all this additional stimulus. You could have unemployment well below 4%. It's 4.1 now. So you could see, as we get into the fall, an exceptionally strong economy that helps them in the election. The other narrative, though, from the Democrats is that there's some very angry voters. I wouldn't point to Alabama, a Republican who was accused of child molestation. That's not the example I would point to. I would point to several other races, though, including the Virginia gubernatorial race, where the turnout was exceptional among African Americans, women, very angry suburban women who hate Trump, and young people. And I have a hunch that the most motivated voters in this fall's election are going to be on the left. They're going to be Democrats. You know, whether you can extrapolate that to 2020, way too soon to say. I didn't get to mention it, so let me just spend 1 minute on 2020. I think if Trump wants to get renominated, he's got it, assuming his health is okay and, you know, Mueller doesn't crush him. I think there's no Republican right now who could beat him. Not John Kasich, not Mitt Romney. I think he would easily win in the primaries, as he did a year and a half ago. He easily beat Kasich. So if Trump wants a nomination, he's got it. Then the question becomes, you know, is the country going to move sharply to the left? The Democrats have a real problem in that their leadership is elderly. You've got Bernie Sanders, 76. You've got Joe Biden, just turned 75. There's such a problem. There's even been talk about Jerry Brown, who's 79, thinking that he might run. So I'm thinking, where's Mike Dukakis? Is he still around? You know, where's Walter Mondale? He's 90. He's still alive in Minneapolis. So the Democrats don't have fresh faces. The Democrats have a pretty elderly group of likely candidates. So they're going to need some fresh blood. You know, is it Elizabeth Warren? Well, she's very, 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 very provocative and polarizing. I'm not sure she's the answer for them. So I'd say that right now, the big story is going to be a very angry electorate turning out in 2018. As far as the geopolitical stories, I mean, if I had to make a bet, I would bet on Angela Merkel putting something together and maintaining her leadership in Germany. I think, and I think my colleagues would agree, that Western Europe looks a hell of a lot better than it did a couple of years ago.
Okay, next question. How about on the left or the right? Yes.
I'll often get the question, is there a point where the 10-year gets attractive where, you know, the market decides, you know, they're more risk off? And what is that point, that breaking point? Is that the point where we get kind of this first pullback? So what is that breaking point?
3% is kind of a magical number on the 10-year. That's pretty much where it ended 2013, and that led to a lot of rotation, people buying back into bonds at that point. No, it's a good question. I think, you know, talk about what ends the bull market. One of the things is going to be competition from other asset classes. So if the Fed gets to 2.5% at the end of their Fed hikes, and you get a 10-year yield at 3, maybe 3.5%, I mean, that could be when people start really reallocating and locking those rates in. What makes this cycle different is it's very unusual to get both corporate margin expansion this late in the cycle. The peak was 2013. It started to decline. You had an earnings recession. Energy got hit. But in the last year, it started to trend back up. So you're getting expanding margins. And now with the tax cut, you're going to get probably 15% EPS growth on the S&P in the coming year. About 8% was organic, maybe 6% from the cut. And that's unusual this late in the cycle. And so you may have more life left in the rally than you typically do. The recovery was so slow for so long. I mean, having 2% GDP growth was the slowest in 60 years. And your recovery and your expansion may be longer because of that. And how long before you exhaust the labor supply? Well, there's the other number of people who want to get back into the labor force. That's not 4%. That number is typically in that 7 to 9% range. And then, frankly, you have a lot of people coming out of prison who are having trouble finding work. And there's a whole study of what do you do with this huge felon population that's, for all intents and purposes, out of the labor force. And that's one of the issues that states are trying to figure out how to fix right now. So you may have a few years left in the rally. I mean, one of the risks is getting out of stocks too early, too soon. I mean, Bob Arnott, Asness, they were concerned about asset returns 5 years ago, in 2012 with the sovereign debt crisis, when the market was trading at 12 times earnings. There are a lot of people who have been incredibly wrong the last 5 years because they were too risk averse. And the real question is, you know, is the market trading at 19 times forward earnings, you know, too far stretched? Or could you actually get the best part of the growth in the next 2 to 3 years?
Is there any potential of Cory Booker coming forward and running, and could he potentially be that candidate that could win some of those Midwest and Pennsylvania?
So if you're looking for fresh blood, I'll keep it brief, but Cory Booker's on the short list. I've met him, very impressive guy. He was a linebacker at Stanford, physically impressive guy, personable. A lot of people say he's a self-promoter, but that's the nature of the business he's in. There are several other names. Kirsten Gillibrand of New York, first rate. She's got a lot going for her. I think Kamala Harris of California needs some seasoning. It's a little too soon, but she's very hungry. She's got sharp elbows. She'll probably run. You might even see Cuomo in New York jump into the race. Can't rule it out. Because he's a brash New Yorker, well, I think we got one already. So there are going to be some, maybe one of the two Castro brothers from San Antonio. So there are going to be some new names in the party. The problem is most people haven't heard of them. Of course, most people hadn't heard of Barack Obama 3 years before the year he won the presidency. But yeah, I'd say Booker would be on the short list. Of all the Democrats I've met, the new one who's impressed me the most is Gillibrand.
I would just add to that, I think the real problem with the Democrats now, it's not the messenger, it's the message. Yep. And I don't think they've figured out what their message is. It's the same problem they had, frankly, in 2016.
Good point.
And if you go back to 1992, you mentioned Jerry Brown. Jerry Brown ran in 1992, but when you think about the rest of the field and who was leading the Democratic Party back then, and it wasn't just Bill Clinton and Al Gore, but you had Bill Bradley, you had Mario Cuomo, you had real heavyweights who had governed and had thought about governing. And when you mention these names now, you really ask them, what would you do differently? Yep. And it gets back to the question of why did Trump win? I mean, Trump didn't win because people were in love with his personality or his character. He won in spite of that. And, the real question is, what do people feel a year from now or 2 years from now in terms of their life changing? People will see their paychecks going up. The vast majority of people will see that. Yep. And the people who pay higher taxes won't really pay them until next year when they realize state deductibility is causing them issues. That'll hit them next April. And so I think when you get to the midterm in November, you might have a tremendous optimism and confidence across the country because people feel like the policies are finally changing. Mm-hmm. Even if they have issues with the people who are creating the policies.
And I just would add very quickly, if there was one overriding message in the last presidential election, it's that Donald Trump stinks is not enough. The Democrats can't run on the agenda that Donald Trump stinks. They have to run on an agenda of standing for something. And I'm not frankly sure what that agenda is.
Well, we've had celebrities, notably, recently in our national politics. There's two that weren't mentioned that have risen a couple of times. One is Oprah, and yep. One, of course, is Michelle Obama. What are the thoughts there?
And don't forget The Rock.
The Rock. I'd like to see somebody win maybe a state legislature seat first before running for president, maybe run for the House before running for president. So we're going to go to another billionaire who doesn't really know much about issues. We just did that. I'm not sure that, Oprah has a following. I'll just say this one thing about Oprah. If there's 15 Democrats running, which is likely, and she, who has a great following among women, African Americans, if she can win 25% in a lot of the primaries, she makes the short list. And the big story in the next primaries is that California is fourth. California used to be last. Now it's Iowa, New Hampshire, South Carolina, California. So there's a lot of people in California, not just Oprah, who think that lightning could strike with the primary being that early.
Very good point. Next question.
Just like your thoughts on maybe on the optimistic side, what we might be missing is, the economic cycle. Maybe we really didn't have an economic cycle, right? I mean, we had an anti-growth administration, in my opinion. In the early days of the Reagan administration, I don't think people were too bullish on some of the things he was doing with regulations and tax cuts. And animal spirits have a life of their own, and these things can run for a number of years. And as far as Trump not knowing a lot about politics, well, like he says, he doesn't have experience, but a lot of people that are in politics have bad experience. So I personally don't think he's a bad thing. I think that technology, we're going through a technology revolution in terms of big enterprises digitizing their businesses. And that could have a massive impact on productivity, and that might be in the market as well. I'm not saying all these things are correct. I'm saying this is sort of a very rosy scenario, which is me, myself, trying to figure out let's leave this thing higher. Just your thoughts on that.
Well, I think if you just look at the indicators, the sentiment indicators, there's no question that confidence has picked up since the election. You know, CEO confidence, small business confidence, and the people who run small businesses have an impact on hiring, and they have an impact on private sector job growth. If you put people to work in the private sector, you end up solving a lot of your problems, including the debt problem. The only way out of the debt problem is to grow quicker as a country. And in order to do that, you have to have more people who are incented to work, and then you have to have more jobs available in the private sector that can pay them. And you have to figure out a way to raise the median pay. It's not just about raising minimum wages. It's about raising median income in the private sector, because ultimately the private sector pays for your public sector. You can't continue to borrow from the future to pay what you're doing today. You haven't earned it. Eventually, markets work, and you're eventually going to have to pay the piper. So I would just say, you know, it's this question of are you on the right track or on the wrong track? I think for most people, when you get more take-home pay and you feel as if your work is being rewarded, you feel things a little bit better today than they were yesterday. But you don't have to pay a mandate to buy health insurance for someone else because you didn't want to opt into it. I've had plenty of conversations with kids in their 20s who just say, I don't like paying a $2,500 tax because I'm told I got to pay for health insurance for other people. I mean, it's a weird place you're at when, you know, people every day come up against something where they feel like their freedom is being inhibited because bureaucrats and unelected officials are throwing down mandates left and right. And, you know, there was a story that came out today about people in California who want to basically create a separate state. They don't like the feeling that they don't have enough freedom over their own lives anymore. And I think that's, you know, a very clear line in the sand in terms of what Trump brings to town. He's definitely an outsider. He's definitely there to shake things up. And people sent him there for a reason. They sent him there because they want him to blow up Washington, and they want things to change. And I wouldn't, you know, take the media's spin on it that this is the reality. I think the reality will be defined when people vote in the midterm. And just like they got the election wrong, they could get the midterm very, very wrong in terms of reading what's going on. And it's not, you know, what happens in LA and New York that matters. What matters is what happens in the 32 states that elected Trump. All you got to do is get those same people to vote the same way, and you can get a midterm election that empowers him, and you can get another 4 years. So my question is, what changes in the red states that voted Trump into power? I think, if anything, things have gotten better there in the last year, including making the wealthy in the blue states pay their fair share to subsidize the tax cuts for the folks in the white states.
And how do you think they feel about the media being against their president?
I think it emboldens folks in the red states.
Let me just say one thing about the media. The media used Trump, and Trump used the media. In the spring of 2016, he was on morning show every morning. He was on CNN. I have a lot of friends at CNN. He was on CNN every day, and I said to them at CNN, "Why do you have Trump on every day?" He said, "It's good for ratings." I said, "Well, would you televise live rooster fights if it was good for ratings?" And they went, "Yeah, probably." So so Trump got his campaign off to an explosive start because of the media. He used the media adroitly. And the media used him because it's good for ratings. He's got this media thing tonight where I'm sure he'll get a lot of more attention. But it's a symbiotic relationship, Trump and the media. It's not all entirely one-sided. And I would argue that his campaign took off because he used the media so skillfully.
I think he still is.
Yeah, I think he is too, absolutely. He's great copy. He's the greatest copy of anyone I've ever followed, no question.
Also, if you donate at least $3 to his campaign, you can win a chance to have dinner with him. So, in case somebody,
Good point, yeah. Yep.
I think you can also enroll in Trump University for the same $3.
Yeah. There you go.
You're
He's a
fired.
very patient man back there who's had his hand up.
If expanding liquidity was the prime motivator of this great bull market, why won't shrinking liquidity be the opposite?
It's one of the big risks that's out there. That's why we're monitoring it. We did a webinar yesterday. We showed one slide. It was the aggregate balance sheet of all the major central banks, and it's still expanding. So the Bank of Japan and the European Central Bank are still printing enough currency to offset the tapering that the Fed is doing. When that plateaus and peaks and goes the other way, yeah, that's definitely something that could end the bull market. No one rings a bell at the top, but that could be one of the bells.
Before we reward our panelists with their well-earned, delicious dinner, each of them has a chance to make a final statement to sum up or what they consider the most important critical issue going forward. Greg, you're...
I might just
You're a
follow up
senior
on
here.
your point, and that is, there's so much BS out there, whether it's in the press. I mean, I read everything in the morning, usually before 6, and I'd say the best news reporting usually is the Wall Street Journal. Not always. I like their news reporting. But everyone has a bias, whether it's Politico or the Washington Post or you name it. Everybody has a bias. And I think that it's fun to follow politics, and Trump is very entertaining, and who knows what he's going to tweet tomorrow morning. That's just part of the act, part of his shtick. But I would just urge everyone, when you see your clients, to focus on the fundamentals. And I think the fundamentals will continue to look extraordinary. I think we got a couple years to go, maybe longer. I think the real impact of this tax cut is that it was an inoculation, a booster shot, almost guaranteeing no recession for another 2 or 3 years. So I think the fundamentals still look absolutely exceptional, despite all the dysfunction in Washington.
So you're all in, Greg, with your retirement
I mean,
plan?
there's things to worry about. There's always things. We always climb a wall of worry. You guys know that.
Mm-hmm.
But I, in all the years I've been doing this, I have rarely seen the fundamentals look as good as they look right now.
Yeah, I would agree with that. But that would be my point of concern. I think if we're coming back a year from now, a lot of the things that seem certain to occur from many different areas are going to seem more uncertain. And the question will be, how do markets respond to that increased uncertainty? So it's said that investors like certainty. They like the idea of consistent earnings growth or economic growth or stability in geopolitics. And all that's true. They do like that. The problem is that certainty breeds complacency, and it tends to be associated with a worse risk reward. The opposite, uncertainty, which is where we were 2 years ago, all of the questions from the audience 2 years ago had a negative slant to it. There were a few questions about recession. There were worries about emerging market debt. There were a lot of commodities. Was crude going to go below $10? What impact that was going to have? That level of uncertainty created opportunity in markets, right? You had a good risk reward in a number of asset classes. When I look around the world today, that certainty is a good thing, and there's no question having a low unemployment rate and having increase in wages and job growth, and these are all great things, but you have to divorce that from the business of investing, which is, looking ahead, looking to the future. And these times where things tend to be certain and you can't imagine them being different, well, something inevitably comes along that seems to break that cycle. So maybe the S&P will be up 10 years in a row. If it's positive this year, it will be the longest streak in history. The longest economic cycle in history was also 10 years from 91 to 2001. Maybe we break that. We're at 8.5. It'll be 9 years this June. Maybe we break that. But if we're looking at risk reward today, it's hard to say that it's compelling. And I think, again, if we're going to come back a year from now, there's going to be a lot of surprises that investors are not anticipating today because, as you said, the fundamentals just seem so good, right? It's hard to imagine things changing.
I would just say I don't know what's going to happen in the year ahead. I just know that when markets are in motion, they tend to stay in motion. until they're impacted by an outside force. The three forces I'm looking at this year is conflict on the Korean Peninsula, which I think could, depending if it escalates, obviously, it could have a huge impact on the market. The midterm election in November. And the third piece is, when does the aggregate balance sheet of the major central banks start to contract? Those are the three things that I think could be that other force that upsets the market. The point that Charlie made earlier about sentiment and valuation is very important. When sentiment was really risk averse in 2012 and the market was trading at 12, 13 times earnings, that's a great time to get in, because you have the ability to get expansion in sentiment, which translates into expansion in valuations, expanding PE multiples. Once you're at a point where 95% of the people are bullish, there's no real room left to expand the optimism and then expand the multiples. So I don't expect the market multiple to expand from these levels. If you're talking about a trailing 23P on the S&P, that's a rich PE. Forward basis, maybe 19. Maybe it grows into it because earnings grow really well in 18, but earnings are likely to slow down in 2019. So I would say, in my best case this year, the market's up 8 to 10%. And you get that because dividends are growing about 6%. The companies are buying back their stock, which equates to about a 2% return. And then you get about 2% from the dividend yield on the S&P. So somewhere returns of 8 to 10%, assuming no expansion in the multiple. You could get a contraction in the multiple if interest rates start going up, and if people feel as if you're getting to the end of the party. So I would try to rein in clients' expectations. I would continue to be diversified, particularly globally on the equity side, but to make sure you have some bonds, some cash, and even thinking about what can help protect me if the markets turn south. Where can I work in some vehicles that lower the overall beta exposure of my portfolio? Because I think you need to start thinking about, how do you protect principal once you get that turnover and once you start heading into the next downturn. But I don't think that happens this year. I think it's a 2019 event.
So great. I'm hearing the theme that I've been using, that we have at least 6 months to 2 years of bull market left, and it ain't over until the fat lady screams or sings, taken from the Philadelphia Flyer lore 40 or 50 years ago. And the fat lady typically is everybody goes all in, and individual investors. With that regard, I've spent most of my career involved in trying to educate investors, people who are educated enough to become my clients, and then also people that don't have the wherewithal to hire someone like me or us in this room. And the organization that I've been involved with since the mid-1980s, it's called Better Investing, and it's the original investment club organization whose focus is enabling ordinary citizens and Americans to become successful lifetime investors. And I was fortunate enough to see a lot of those. It sort of reinforced what I learned seeing my father and his friends in the 50s. So there were people like that. But no one believed that the stock market wasn't a dangerous place at that time. In 2008, 2009, we were at that point of the sum of all fears, to quote a book and a movie. People couldn't be any more scared than they were. And I realized that it was a generational thing, and it took 25 years for people to come back into the stock market at all after 1929. Hopefully it doesn't take 25 years now. One of the issues I see is the maldistribution of wealth, which has gotten worse and worse in the last 30 years. And I was taught in the early 60s, when I first studied these matters, that was one of the causes of the Great Depression. And we've tied 1929, I think, for the worst maldistribution since 1900. It probably was worse in the age of the robber barons. But when you get an event that is startling, like the crash in 29 or like what we had in 08, 09, most people reduce their consumption. Either they're forced to, or the wealthy, don't do some of the spending that they used to do. And the problem was the average person didn't have the savings, didn't have the buffer in the 1930s, and along with other factors, we had a depression. So people were scared of a depression in the 50s. It kept them from investing until the late 60s and later. I saw that market cycle end. Then actually 1966 was adjusted for inflation, the peak. 1974 was the low after several bear markets. And then we didn't break out into a new bull market until August of 1982. And it went on much longer than anyone expected. Certainly we had bear events like 1987, but the bull market didn't end until it ended with exceptional greed and folly by 1999, 2000, when pigs were flying. I don't see that yet, but I'm on the outlook for it, and when I talk to my clients, I always ask them, are people talking about stock? Are they investing? Are they asking you? And the tragedy is they aren't, particularly the millennials and the people that are in mid-career now and need to provide for much of their own retirement. I'm sure most of us have children and grandchildren that may be in that era. So the CFA Institute is putting an emphasis on us giving back by educating the public. That's something that I'm big about. And if there are any that are interested in that area, we may develop a SWAT team at the CFA Society to do it. I know we do it in April when there's a Smart Investor Week and the one that's sponsored by the Federal Reserve. So those are my concluding thoughts. I thank you all for coming. I apologize for the infelicities of the evening, not least of all that suffering back spasms as well as probably the onset of a flu. So I had to sit down during some of the event, something I don't like to do. But our panel was terrific. They met and exceeded my expectations and hopefully were of great value to you. I know, like a fine wine or perhaps peppercorns, some of the little nuggets will explode a bit later on and be inspirational. So, thank you for coming. Good luck and good night. And